One number, $190 billion. What Microsoft just bet on AI? More than Amazon earns in a year. The reason to buy or the reason to run? 6 legends, 3 lenses, 1 score. Let's judge it.
In June 2026, Microsoft reported its best Azure quarter in years, 40% growth, and the stock fell 5%. That tells you everything this episode is about. Azure grew 40% year over year. The contracted backlog hit $625 billion, up over 100%, but here is the number that sent the stock down. $190 billion of capital expenditure, 61% more than last year. Free cash flow compresses from $55 billion toward $20 to $25 billion as the spending ramps. The franchise is growing, the cash is being committed. And the price, 23 times forward earnings, 28% below the 10-year median. The cheapest Microsoft has been relative to its own history in a decade. Now the question the board has to answer. Every single legend on this board will agree the moat is real. Azure is dominant. The franchise is extraordinary. They split on one thing. At what point does a moat become a capital trap? That is what 6 of history's greatest investors are about to disagree on. First lens, 6 legends, their frameworks, the score that splits them. Philip Fisher, the father of growth investing. One question above all, is management reinvesting wisely at a rate that extends the moat?
Fisher's model has one lens. Does management reinvest at scale to build a dominant position? Azure 40%, a $625 billion backlog, the clearest answer he has ever seen. Demand is real, the capital is chasing it. The cash flow compression is real, and he accepts it. That is what franchise extension costs. Every great franchise he studied went through a moment where the capital commitment looked terrifying from the outside. He backs management when the evidence is this clear. He scores it a 7.
A 7, the franchise investor is nearly fully in. Now the man who follows the tide. Stanley Druckenmiller, 30 years, not a single losing one. His model asks one question first: is there a secular wave large enough to lift this?
Druckenmiller's framework puts AI infrastructure as the single largest secular theme of the decade. And Microsoft is the most defensible platform for that theme. Azure is not just participating in AI, it is the infrastructure layer the rest of the industry runs on. But the 5% drop on the CapEx announcement tells him something. The smart money expressed doubt about payback timing, not the thesis. He is long. He is not at maximum conviction. The tide is confirmed. The calendar is not. He scores it a 6.
A 6 in but not all in. Now the man who tests every price. Peter Lynch ran Magellan to 29% annual returns for 13 years. His system: buy growing companies before the PEG crosses 1.
Lynch's model runs the PEG price to earnings relative to growth. The 23 times PE looks low, but the CapEx compresses the earnings growth rate for 2 to 3 years. That pushes the PEG toward 1.5 to 2.3. Lynch hunts below 1. And then the pattern he warned investors against: spending beyond the line of business you understand. $190 billion is a number Microsoft couldn't have imagined 10 years ago. He likes the franchise. He doesn't like this price with this PEG after this commitment. He scores it a 4.
A 4, the PEG master has reservations. Now, the man who built a philosophy around one word: predictability. Warren Buffett, his rules are simple and absolute: buy businesses with predictable cash flows at fair prices. He has never owned Microsoft. His reason tells you everything.
Buffett's first requirement is predictability. The $190 billion commitment does exactly one thing to it: breaks it. Free cash flow is compressed for 3 to 5 years. The outcome depends on AI returns nobody can model today. His second problem: circle of competence. He has said explicitly he cannot evaluate the return on AI infrastructure with any confidence. The franchise is extraordinary. He won't underwrite a $190 billion bet he can't stress test. He acknowledges the moat. He cannot sign off on the bet. He scores it a 3.
A 3, even the Oracle says the moat is real and the bet is too big to price. Now the man who invented the margin of safety. Benjamin Graham, he taught Buffett. His whole framework is one question: how much can you be wrong and still not lose money?
Graham's model runs downside first. Where is the margin of safety if AI demand softens? The $625 billion in backlog sounds like a floor, but contracts are cancelable. The capex has already been committed. The asymmetry is dangerous. At 23 times forward earnings, with compressed cash and an irreversible commitment, there is no floor. You're paying the price of optimism with no room to be wrong. He scores it a 2, the lowest on this board. One legend left.
7, 6, 4, 3, 2, and one voice still to come. This one surprises everyone. Joel Greenblatt, 40% annual returns for 10 years. His method is simple: buy good businesses at cheap prices, run the numbers, and right now the numbers do something none of the others expected. So what does his formula see?
Greenblatt's magic formula scores 2 things: earnings yield and return on invested capital. At 23 times forward earnings, Microsoft's earnings yield is about 4.3%, higher than most megacap peers. The pre-capex return on capital is extraordinary, 35 to 40%. His formula flags this. His formula sees what the others walked past. The market is pricing in capex failure. If the market is wrong, the gap between what you paid and what you earn is enormous. That gap is his edge. He accepts the uncertainty. Quality franchise at a discount, penalized for a fear that hasn't materialized. That is what his formula hunts. He scores it a 7, tied highest. That is the surprise.
A 7, the formula investor found the discount everyone else walked past. But wait until you see what the scores add up to. Fisher 7, Druckenmiller 6, Greenblatt 7, Lynch 4, Buffett 3, Graham 2. The great score for Microsoft, June 2026, 4.8 out of 10. A 4.8 usually means average and unremarkable. This is the opposite. It is the average of a 7 and a 2. The 5-point spread is the score, not the 4.8. What splits them isn't the moat. Everyone agrees the moat is real. It is the bet. Fisher and Greenblatt see a dominant franchise reinvesting at a discount to history. Lynch, Buffett, and Graham see irreversible capex on an unproven AI return with no floor. Druckenmiller rides the tide but watches his sizing. One company, 2 perfectly coherent answers. The board judged the method and split harder than on any company yet. So now the question only the living can answer. Of the investors who actually move billions today, who is buying Microsoft at this price in the middle of the biggest spending spree in its history? We pulled the filings. 4 of our 15 tracked legends hold Microsoft. That sounds like consensus until you read the action. Bill Ackman opened a $2 billion position right after the capex shock drop, but Chris Hohn and David Tepper both trimmed, present in many portfolios, high conviction in very few. And that is the Microsoft tell. Unlike Intel, where one brave investor stood alone, Microsoft sits in almost every portfolio we track. The question is not who owns it, it is who is adding at this price. Ackman is betting the drop was the opportunity. The trimmers are betting the capex bill comes due first. And the crowd, Microsoft pulls nearly 2.5 times the public attention of the average megacap, elevated but not euphoric. This is not the retail frenzy around Nvidia. It is a serious story watched closely after a drop, which means some of the upside is already in the price. To win from here, Azure has to beat what the crowd already expects. The franchise is at 28% below its own historical price. The AI wave is real. If the capex pays off, this was a dominant franchise bought at a once-in-a-decade discount. Greenblatt's formula, Fisher's franchise lens, and Druckenmiller's secular theme all point the same direction. The PEG doesn't screen, the cash flow is not predictable, the capex is irreversible, and the AI return is unproven. Lynch, Buffett, and Graham would all say the same thing: the franchise is not the question, the price of the bet you're taking to own it, that is the question. 4.8 out of 10, The CapEx bet. The franchise is real. The moat is agreed. The board splits on one thing. When does this bet pay off? And what happens if the timeline slips? 3 things to watch. Does Azure stay above 30% as the CapEx ramps? Does free cash flow recover in 2027 or slide further? And does any major AI product, Copilot, Enterprise AI, show measurable revenue return on the infrastructure? Those answers decide which side of this board was right. This was the Greats Playbook, where history's greatest minds judge the companies of today. Numbers from June 2026. Methods are timeless. These are models of published frameworks, not the investors themselves, and absolutely not financial advice. Which company should the board judge next? Study the greats, then think for yourself.